Before we travel through centuries of financial madness, let's take a moment to set the stage. Markets are supposed to be rational. Prices are supposed to reflect value. And investors are supposed to think carefully before they act. At least that's what the textbooks tell us. But in the real world, markets behave a lot more like crowds. Emotional, unpredictable, and sometimes completely detached from reality. Every so often, a new idea, a new technology, or even a simple flower captures our imagination. And when that happens, something strange begins to grow: excitement, speculation, and eventually a bubble. This video isn't about charts or complicated financial theories. It's about stories. Stories of real people, real decisions, and real consequences. Stories that repeat across time, from tulips to tech. And more importantly, it's about what these stories reveal about us, our hopes, our fears, and our irresistible desire to believe in the next big thing. So sit back, relax, and let's explore why bubbles keep forming, why they always burst, and what they can teach us about the world we're living in today. Imagine waking up one morning and realizing the flower in your garden is now worth more than your house. Not because it suddenly gained magical powers, but simply because everyone else decided it was rare, beautiful, and might be worth even more tomorrow. This sounds absurd, but it actually happened. And not just once, but many, many times throughout history. From tulips to housing, from railroads to the internet, and now to modern tech and crypto financial bubbles. Keep returning in slightly different costumes, but with the same predictable ending. Today, we're going to unravel why markets inflate, why people get swept up in the madness, and how each generation convinces itself that this time things are different. This is the story of market bubbles explained simply from tulips to tech. Before we start, let's define a bubble in the most straightforward way. Think of value as two layers. The first layer is what something is actually worth: its real usefulness, its income, its function. That's the fundamental value. The second layer is what people believe it will be worth in the future. That's speculative value. A bubble happens when that second layer grows far larger than the first. When price stops reflecting reality and starts reflecting hopes, dreams, hype, and sometimes pure fantasy. A bubble is not just a high price. High prices can be reasonable. A bubble is when people buy something mainly because they expect someone else to buy it later for more. And when that expectation breaks, so does the bubble. To understand how this works, let's travel back to the 17th century, to a small country with a big passion for flowers. In the 1630s, the Netherlands was experiencing a golden age. Trade was booming, wealth was growing, and a new exotic flower had captured the imagination of the nation: the tulip. Tulips weren't just beautiful. They were rare, especially the multicolored ones, created by a mysterious virus that caused their petals to form dramatic streaks. These weren't seen as diseased flowers, they were viewed as art. People began collecting tulips the way we collect luxury watches or rare sneakers today. At first, wealthy merchants bought them to show status, but soon traders, craftsmen, and everyday townspeople wanted in. Prices rose steadily, then faster, then uncontrollably. A single tulip bulb could be exchanged for a wagon of grain, a dozen sheep, and even a house. Some bulbs sold for 10 times the annual income of a skilled worker. What fueled this madness? Not utility. You can't eat a tulip. You can't live in it. You can't power a ship with it. What fueled the rise was the belief that someone else would pay even more later. People weren't buying tulips, they were buying the expectation of future buyers. This psychological loop intensified until one day at a routine auction, buyers simply stopped bidding. Nobody wanted to pay the absurd prices anymore. And when demand collapsed, prices fell faster than they had risen. Fortunes evaporated and the tulip market crashed. The Tulip Mania wasn't the biggest bubble in history, but it was the first one so famous that economists still reference it today. It taught an early lesson: when price disconnects from reality, emotions take over, and emotions don't last. Let's jump forward to another bubble, one filled not with flowers, but promises. In 1720, Britain was swept into the South Sea bubble. A company called the South Sea Company pitched a grand vision: massive profits from trade in South America. In reality, the company had limited business and almost no real operations. But the idea sounded incredible. Investors, including politicians and wealthy elites, poured money into it. What made this bubble dangerous was the combination of excitement, political influence, and aggressive marketing. The company kept promising more bigger profits, bigger opportunities, bigger futures. And the public believed it. Share prices skyrocketed. People borrowed money to buy shares selling their homes and businesses to get in. But trade profits never came. The hype collapsed, shares crashed, and thousands were ruined. Even Isaac Newton, one of the greatest minds in history, lost most of his savings. After the crash, he famously said, "I can calculate the motion of heavenly bodies, but not the madness of men." That quote captures something essential about bubbles. They're driven not by numbers, but by psychology. Now let's fast forward to the late 1990s, when technology promised a new era. The internet was exploding onto the world stage. New websites, new companies, and new ideas appeared every day. Everyone believed this new frontier would change everything, and they were right. But they were also impatient. Investors didn't want slow, steady growth. They wanted instant billion-dollar success. The dot-com era became the Wild West of modern finance. Companies with no revenue, no profit, and sometimes no real product were valued in the hundreds of millions simply because they had .com in their names. Anything, even a business plan written on a napkin, could attract huge investment. People talked about a new economy where traditional rules didn't apply. Old metrics like profits and cash flow were considered outdated. Growth eyeballs and potential were all that mattered. But the problem with potential is that it's not guaranteed. Eventually, reality caught up. Many internet companies burned through their cash and collapsed. In 2000, the bubble burst. The Nasdaq fell nearly 80%, and countless startups vanished overnight. But here's the twist. Unlike Tulips or the South Sea Company, the underlying technology was real. The internet truly was revolutionary. The mistake wasn't believing in the future. It was overestimating how fast that future would arrive. This brings us to 2008, a bubble not in flowers or tech companies, but in something far more fundamental: homes. For many people, buying a house is the biggest financial decision they'll ever make. It feels safe, stable, and dependable. But in the early 2000s, a dangerous myth spread that housing prices always go up. Banks began offering easy loans to people who couldn't really afford them. These loans were then bundled into financial products that looked safe on paper, but were actually extremely risky. Investors bought them thinking they were solid because the models said so. And because everyone believed home prices would keep rising, the system felt invincible. Of course, prices didn't rise forever. When homeowners started defaulting, the financial products tied to those loans began failing. Banks suffered massive losses. Panic spread. And the entire global economy shook. Unlike tulips or dot-coms, the housing bubble was deeply intertwined with the everyday economy. Its collapse caused real hardship, unemployment, and lasting damage. It showed how bubbles can spread far beyond investors and affect society as a whole. Now let's move into more recent years, where we encounter modern bubbles, crypto NFTs, and tech startups. Bitcoin introduced the world to digital scarcity. NFTs introduced digital ownership. AI startups introduced visions of a radically automated future. All of these concepts have genuine potential, but potential isn't the same as value. During the crypto boom, people paid millions for digital images that anyone could screenshot. They bought tokens with no utility besides hype. They invested in coins named after memes. And they did this because they believed prices would keep climbing. Some did briefly. Then crashes wiped out billions of dollars in value almost overnight. With AI, valuations for early-stage companies surged to unprecedented levels. A startup with no revenue could be worth billions simply for having a promising model. Investors feared missing out on the next revolutionary breakthrough. So money poured in faster than real progress could justify. And this brings us to a question. Are we in a bubble right now? The truth is, we won't know until hindsight makes things obvious. But history teaches us that whenever expectations grow faster than real value, caution is wise. So why do bubbles keep happening? Why haven't we learned our lesson after hundreds of years? The answer comes down to psychology, specifically 3 major forces. The first is FOMO, the fear of missing out. When people around us are making money, we don't want to be left behind. We imagine a future where everyone else gets rich except us. So we invest not because we understand the thing, but because we fear watching others succeed without us. The second force is herd mentality. Humans are social creatures. When a crowd believes something, it feels safe to join them. If thousands of people are buying tulips or .com stocks or crypto coins, it feels like validation. Surely they can't all be wrong. But bubbles show us that sometimes the crowd can be spectacularly wrong. The third force is the greater fool theory. This is the belief that no matter how inflated a price becomes, someone else, a greater fool, will buy it at an even higher price. You don't have to be right about the asset's value. You just have to sell it before the music stops. The problem is that eventually the number of fools runs out. So how can we recognize when a bubble might be forming? There are a few signs that appear almost every time. First, prices rise extremely fast, often without any change in fundamentals. If something's value doubles in a week for no real reason, that's a warning sign. Second, people stop talking about what something is and start talking only about what it could be. When the conversation shifts from reality to pure speculation, be careful. Third, when everyone, your friends, your relatives, even people who normally avoid investing, rushes into the same thing, that's a classic indicator. When skepticism disappears and optimism becomes universal, bubbles often aren't far behind. But here's the important part. Bubbles are not entirely bad. They can accelerate innovation. They can bring attention, talent, and capital to new industries. The .com bubble created a lot of failures, but it also funded the infrastructure of the modern internet. The AI boom today might contain bubbles, but it's also speeding up real research and breakthroughs. The lesson isn't to avoid all risk. It's to understand the difference between long-term value and temporary excitement. To be cautious when hype exceeds reality. And to remember that markets move in cycles, not straight lines. If we zoom out from tulips to tech, one pattern stands out. Human optimism is powerful. It builds cities, funds inventions, and drives progress. But unchecked optimism can also detach us from reality. And when it does, the correction is often painful. So the story of bubbles is really the story of us, our hopes, our fears, our dreams, and our tendency to believe that just this once, we won't repeat the mistakes of the past. But history suggests we probably will. And maybe that's okay. Because each bubble, no matter how chaotic, pushes the world forward in strange and unexpected ways. The key is to participate with awareness, not blind belief. So as we watch today's markets from crypto to AI to emerging tech, the big question is not whether another bubble will form. It's which one will form next, how big it will grow, and who will be left holding it when it bursts. And that leads to one final question for you. Which market do you think is inflating right now? And will we look back decades from today and say, of course it was a bubble, why didn't we see it? Whatever the answer is, history suggests one thing. The cycle will continue. The players will change, the assets will change, but the psychology will stay the same. And that's why understanding bubbles isn't just about finance. It's about understanding human nature itself. Market bubbles might look different on the surface: flowers, shipping companies, websites, houses, cryptocurrencies, AI startups. But underneath, they all follow the same rhythm. A spark, a story, a surge. And finally, the moment when expectations collapse under their own weight. But bubbles aren't just warnings. They're also reminders of how powerful human imagination can be. They push industries forward, fund new ideas, and reveal what people value or think they value at a moment in time. And while they often end painfully, the world that emerges afterward is usually more advanced than before. So the real question isn't whether another bubble will form. It will. The real question is, which story are we living through right now? And more importantly, are we participants observers, or the ones who will look back and say, I should have seen it coming? If you enjoyed this explanation and want more deep dives into complex ideas made simple, feel free to follow along. There's always another story to uncover, another pattern to explore, and another lesson hidden in plain sight. Thanks for listening, and until next time, stay curious.